Ladies and gentlemen, what you're about to hear will challenge everything you think you know about markets. They just dumped silver, one of the most critical materials powering solar panels, electric vehicles, and the entire energy transition, and they want you to believe it's normal. But what if this isn't price discovery? What if this is a system under stress liquidating the future to survive the present? While algorithms trade in microseconds, factories are scaling and they dump silver. Let that sink in. In a world where uncertainty is rising, currencies are being printed at historic rates and volatility has become the norm. They walked away from one of the oldest hard assets known to civilization. And that tells you something bigger than a price chart ever could. This is not just about silver. This is about what happens when markets stop reflecting reality and start reflecting fear, leverage, and short-term algorithms. And at Tesla, first principles thinking means stripping a problem down to its fundamental truths and building back up from there. Apply that to silver. What is silver? It's not just a precious metal. It's a critical industrial material. It's in solar panels, high-efficiency electronics, battery systems, grid infrastructure, and advanced manufacturing. It's a key input in the transition to sustainable energy. Demand is not theoretical. It's physical. It's engineered. It's deployed at scale. And now look at the broader energy transformation. The world is moving from fossil fuel dependency toward electrification. Electric vehicles, energy storage systems, solar generation, AI-driven data centers, all of it requires conductive, reliable materials. Silver has the highest electrical conductivity of any metal. That's physics. That's not sentiment. And physics doesn't care about quarterly earnings calls or hedge fund positioning. And so when large players dump silver, aggressively pushing prices in directions disconnected from long-term industrial demand, you have to ask, is this price discovery, or is it liquidity stress? Is it fundamentals, or is it margin calls? Because real markets allocate capital toward long-term value creation. Distorted markets chase short-term survival. And the same mindset that questions legacy automakers applies here. When we looked at transportation, we didn't accept the assumption that internal combustion was the final form. We questioned cost curves, battery chemistry, software integration, vertical manufacturing. We saw that as battery costs decline and production scales, electric becomes inevitable. The market didn't believe it at first. The stock didn't reflect it at first. But physics and manufacturing economics eventually overpower narrative. And silver is similar. If global electrification accelerates, industrial demand compounds, solar installations scale, grid storage expands, semiconductor manufacturing intensifies, robotics and automation grow, each of these sectors pulls on conductive materials. You cannot print silver. You must mine it, refine it, distribute it. Supply is constrained by geology and capital expenditure cycles that take years, sometimes decades. But modern financial markets operate on microseconds. Algorithms trade headlines. Funds rebalance risk instantly. Liquidity dries up and positions are liquidated regardless of long-term value. In that environment, price can detach from physical reality. And when that detachment becomes frequent, confidence erodes. Investors begin to question whether the market is allocating capital efficiently or simply amplifying volatility. And this is not new. When disruptive technology emerges, incumbents underestimate it. When structural shifts occur, markets initially misprice them. The early days of electric vehicles were met with skepticism. The early days of large-scale battery storage were dismissed as impractical. Yet cost curves and engineering iteration changed everything. The same principle applies to materials critical to the energy transition. And if silver is essential to solar cells and solar is essential to decarbonization, then long-term demand is structurally embedded in global policy and corporate strategy. Governments are subsidizing renewables. Corporations are committing to net zero targets. Utilities are modernizing grids. These are multi-decade shifts, not quarterly trades. And so when you see a sharp sell-off labeled as "they dumped silver," it may reflect liquidity pressures in a leveraged system, rather than a collapse in intrinsic utility. It may reveal how interconnected and fragile the financial layer has become. A real market aligns price with long-term value creation. A distorted market amplifies short-term stress. And the deeper issue is trust. Markets function when participants believe that prices incorporate information rationally over time. But when price swings feel disconnected from physical supply chains, manufacturing demand, and technological trajectories, skepticism grows. That skepticism fuels volatility, which fuels more forced selling, which further disconnects price from fundamentals. And at Tesla, scaling manufacturing required ignoring short-term noise. Building gigafactories required capital discipline and long-term vision. Integrating software with hardware required rethinking automotive architecture. None of that would have survived if decisions were based solely on daily market fluctuations. And the energy transition is a physical transformation of infrastructure. It requires metals, minerals, batteries, semiconductors, and software. It is constrained by chemistry, physics, and engineering, not by trading sentiment. When markets price critical inputs as if demand is optional, they signal instability in the financial layer, not necessarily weakness in the physical economy. And they dumped silver. But the question isn't who sold. The question is whether the sell-off reflects a change in physical demand or simply a system stretched thin by leverage and short-termism. In a world accelerating toward electrification, conductivity and scalability matter more than ever. When markets forget that volatility replaces vision. And when markets forget that volatility replaces vision. And volatility, when untethered from fundamentals, becomes a tax on progress. It reallocates attention away from building and toward reacting. It rewards speed over substance. It prioritizes leverage over longevity. That's the core distortion. And if you zoom out and apply systems thinking, you see two layers operating simultaneously. The physical layer is factories, mines, refineries, power plants, battery cells, transmission lines, and vehicles on the road. The financial layer is derivatives, ETFs, margin accounts, risk models, and high-frequency execution. The physical layer moves at the speed of permitting, construction, and chemistry. The financial layer moves at the speed of light. And when those two layers are aligned, capital flows efficiently into productive assets. Mines expand responsibly. Refining capacity scales. Recycling technology improves. Manufacturers secure long-term supply agreements. But when the financial layer becomes hyperreactive, short-term price swings can starve long-term projects of stable capital. That's when a market starts to feel less like a mechanism for value discovery and more like a volatility engine. And think about scaling battery production. It required massive upfront investment before economies of scale drove costs down. If capital had fled every time commodity prices dipped temporarily, that scaling would have stalled. Instead, conviction in long-term electrification overrode short-term noise. That is how structural transformation happens. And silver sits at the intersection of multiple exponential curves. Solar deployment is compounding globally. Electric vehicle adoption is accelerating as battery costs decline and charging infrastructure expands. Energy storage systems are becoming central to grid resilience. AI infrastructure requires dense, power-hungry data centers. Each of these trends increases electrical throughput, and higher throughput demands highly conductive materials. And there's also a geopolitical layer. Supply chains are being reevaluated for resilience. Countries are prioritizing domestic manufacturing capacity for critical technologies. Strategic materials are being reassessed not just for price but for security of supply. When a material plays a role in renewable generation electronics and defense applications, its importance extends beyond spot pricing. And yet, in a leveraged system, a spike in bond yields or a liquidity crunch in another asset class can trigger forced selling across unrelated markets. A fund needing to meet redemptions may liquidate commodities regardless of their long-term outlook. That cascade can create the illusion of weakening demand, even when order books in the physical market remain stable. And this is where first principles analysis becomes essential. Strip away the noise. Ask, has the physics changed? Has conductivity been redefined? Has solar efficiency stopped improving? Has electrification reversed course? If the underlying drivers remain intact, then price dislocation is a financial phenomenon, not a structural collapse. And innovation also changes how materials are used. Engineers continuously work to reduce silver intensity per solar cell, optimizing cost efficiency. At the same time, total installation volumes rise dramatically. Efficiency gains in usage per unit can coexist with rising aggregate demand. Markets often struggle to model that dynamic because it requires understanding both micro-level engineering improvements and macro-level adoption curves. And the same was true in automotive manufacturing. Efficiency per vehicle improved, but total production scaled. Software integration reduced hardware complexity in some areas while increasing computational demand in others. Progress is nonlinear. It involves trade-offs, redesigns, and step function improvements. And if markets are pricing silver as though electrification is slowing permanently, that assumption must be stress-tested against data. Global climate commitments have not been rescinded. Grid modernization is ongoing. Consumer adoption of electric vehicles continues to expand as total cost of ownership improves. Energy storage deployments are rising to stabilize renewable heavy grids. These are measurable trends. And a distorted market environment can also create opportunity. When capital misprices critical inputs, long-term operators with strong balance sheets can secure supply at advantageous terms. Vertical integration becomes more attractive. Recycling technology investment becomes strategic. Efficiency improvements accelerate to reduce exposure to commodity volatility. And this is the discipline required in an era of rapid transformation. Separate structural signals from cyclical noise. Focus on throughput scalability and cost curves. Evaluate whether supply growth can realistically match projected demand under multiple scenarios. Recognize that short-term price weakness does not invalidate long-term necessity. And the broader message is not about defending a single metal. It's about recognizing how fragile the financial superstructure can become when leverage and speed dominate decision-making. Real progress, building factories, deploying renewable infrastructure, advancing battery chemistry, requires patience and capital stability. When those are undermined by reactive trading dynamics, the disconnect becomes visible. And markets are powerful tools when they allocate resources efficiently. But they are not infallible. They can overshoot. They can panic. They can liquidate indiscriminately. In those moments, long-term builders rely on data engineering realities and mission alignment rather than headlines. And if electrification continues, if renewable deployment scales, if digital infrastructure expands, then conductive materials remain foundational. The trajectory of sustainable energy does not hinge on daily volatility. It hinges on cost declines, manufacturing innovation, and global adoption curves. When price action diverges from those fundamentals, the divergence says more about the structure of the market than about the direction of the future. And when price action diverges from those fundamentals, the divergence says more about the structure of the market than about the direction of the future. And the structure right now reveals something critical. We are transitioning from an old energy paradigm to a new one, while still using financial frameworks built for the previous era. That mismatch creates friction. And legacy energy systems were centralized, fuel-based, and relatively linear. Extraction, transport, combustion. The economics were well understood. Commodities were consumed and replenished on predictable cycles. But electrification is networked, software-driven, and exponentially scaling. It integrates generation, storage, and intelligent load balancing. It relies on materials science, semiconductor design, and advanced manufacturing techniques. The demand curves are steeper and the feedback loops are faster. And financial markets, however, often default to linear models. They extrapolate recent price trends. They overemphasize quarterly signals. They react to macro headlines without recalibrating for technological inflection points. When a material like silver is tied to exponential technologies, linear pricing assumptions can break down. And consider the scaling effect of distributed solar. Every rooftop installation adds incremental demand. Utility scale projects multiply that demand by orders of magnitude. Pair those systems with battery storage and the complexity, and material intensity expands. Electrify transportation fleets and grid load patterns shift. Introduce AI-managed energy optimization, and you increase computational requirements. Each layer compounds the previous one. And in that environment, supply constraints matter. Mining projects require exploration, permitting, financing, and construction. Environmental standards are rising as they should. That increases timelines. Refining capacity cannot be built overnight. Recycling infrastructure must be engineered and scaled. The physical world has inertia. And now layer on capital volatility. If price swings deter investment in new supply, the gap between future demand and available material widens. That sets the stage for sharper corrections later. A market that suppresses long-term investment through instability ultimately amplifies future instability. It becomes cyclical rather than strategic. And there's also the innovation factor. As technology advances, new applications emerge that were previously impractical. High-efficiency power electronics, advanced sensors, next-generation photovoltaic designs. Each iteration can subtly alter material requirements. Markets struggle to quantify optionality. They prefer visible data over emergent potential. But transformation is driven by what is becoming possible, not only by what is currently deployed. And the same dynamic unfolded in electric vehicles. Early models were niche. Range anxiety dominated narratives. Charging infrastructure was sparse. Yet battery energy density improved, manufacturing scaled, and software integration enhanced performance. The inflection point arrived faster than many projections suggested. Once cost parity approaches, adoption accelerates. And if the energy transition follows a similar S-curve, demand for enabling materials can shift from gradual to rapid. That acceleration can catch linear forecasts off guard. When that happens, repricing is not subtle. It is abrupt. And another factor often overlooked is resilience. Climate volatility is increasing. Grid stability is becoming more critical. Distributed generation and storage provide redundancy. Materials that enable reliable energy flow become part of national infrastructure strategy. Their value extends beyond commodity classification into strategic classification. And a market focused narrowly on short-term liquidity events may not account for that shift. It may treat all metals as interchangeable risk assets, rather than differentiated components of an energy transformation. That generalization simplifies trading models, but distorts long-term capital allocation. And for builders, the response is clarity. Secure supply chains. Diversify sourcing. Invest in recycling and material efficiency. Pursue vertical integration where it improves stability. Reduce dependency on unpredictable pricing cycles. Align engineering roadmaps with realistic resource planning. And for investors, the response is discipline. Distinguish between forced selling and structural decline. Analyze end-use demand rather than ticker momentum. Evaluate whether policy, technology, and consumer behavior are reinforcing or contradicting price trends. And the phrase, "not a real market," reflects frustration with volatility, but the deeper issue is alignment. A real market should reflect aggregated information about future value creation. When price becomes dominated by leverage unwind cycles, it temporarily loses that signaling function. And however, volatility does not erase trajectory. The shift toward electrification is anchored in efficiency. Electric drivetrains convert energy more effectively than combustion engines. Solar and wind have no fuel costs once installed. Battery storage smooths intermittency. Software optimizes distribution. These are structural advantages. And materials that enable these advantages remain embedded in the system's architecture. As long as efficiency, sustainability, and scalability drive global priorities, the foundational inputs retain strategic importance. Price can oscillate. Sentiment can reverse. Liquidity can contract. But the underlying engineering logic persists. And an engineering logic, when paired with scale, eventually exerts gravitational pull on markets. It rewards long-term investment. It penalizes underestimation of exponential growth. It reshapes cost curves and competitive landscapes. And in times of dislocation, the temptation is to react, to interpret every sell-off as a verdict. But building transformative systems requires resisting that impulse. It requires evaluating whether fundamentals have shifted, or whether the financial layer is simply recalibrating under stress. And if the core drivers, electrification, renewable expansion, digital infrastructure growth, remain intact, then volatility becomes a phase, not a forecast. And in a world where physics and innovation dictate direction, short-term distortions cannot permanently override long-term necessity. And in a world where physics and innovation dictate direction, short-term distortions cannot permanently override long-term necessity. The arc of transformation may bend under pressure, but it does not reverse because a trading desk unwinds a position. It responds to energy density, to conductivity, to efficiency gains measured in real-world deployment, not in intraday volatility. And look at the capital intensity required to build the next generation of infrastructure. Gigafactories do not emerge from quarterly optimism. They are constructed from multi-year conviction. High-capacity transmission lines are not financed on weekly momentum. They are justified by decades of projected load growth. Advanced manufacturing ecosystems do not stabilize on speculative spikes. They require predictable supply, strategic partnerships, and long-horizon planning. And when markets become hypersensitive, executives are forced to navigate a paradox. They must invest aggressively into a future that the price signals temporarily question. That tension separates operators from traders. Operators study throughput, yield rates, defect reduction, and cost per kilowatt hour. Traders study spreads, liquidity, and implied volatility. Both play roles in a functioning economy, but when one dominates excessively, imbalance follows. And the energy transition is not a narrative trend. It is a thermodynamic upgrade. Electric systems reduce entropy losses compared to combustion-based systems. Software-defined energy management reduces waste. Autonomous optimization improves routing efficiency. Each improvement compounds savings across millions of nodes in a network. Materials that enable these gains become embedded in that compounding equation. And silver's role in high-efficiency photovoltaic cells is one example of how microscopic engineering decisions scale into macroeconomic shifts. A thin conductive layer optimized for minimal resistance repeated across billions of cells translates into terawatt-hours of clean generation over time. Multiply that across continents and the aggregate impact becomes structural. And financial markets, however, often compress that complexity into a single price line. Up or down, risk on or risk off. That binary framing obscures nuance. A decline in price might reflect currency fluctuations, interest rate expectations, or cross-asset deleveraging, rather than a deterioration in industrial consumption. Without dissecting the drivers, conclusions become simplistic. And there is also the behavioral dimension. In volatile environments, herding intensifies. Participants seek confirmation in collective movement. If silver is falling, it must be weak. If it is rising, it must be strong. Yet underlying procurement contracts between manufacturers and suppliers often operate on entirely different timelines. Long-term offtake agreements, hedging strategies, and inventory management plans buffer industrial activity from daily swings. And this divergence can persist until a catalyst forces reconciliation. That catalyst could be a supply disruption, an unexpected surge in installation rates, or policy acceleration. When reconciliation occurs, repricing can be sharp because positioning was built on incomplete assumptions. And from a systems perspective, resilience comes from integration. The more vertically integrated an energy ecosystem becomes, from raw material extraction to finished product deployment, the less exposed it is to episodic market turbulence. Control over supply chains enhances predictability. Predictability supports scaling. Scaling drives cost reduction. Cost reduction accelerates adoption. Adoption reinforces demand for foundational materials. And that feedback loop is the engine of transformation. It does not operate on sentiment cycles. It operates on learning curves. Each doubling of cumulative production tends to reduce unit costs through experience and process optimization. This phenomenon has been observed in batteries, solar modules, and power electronics. As costs decline, addressable markets expand. And if demand expansion outpaces supply growth due to underinvestment triggered by volatility, structural tightness can emerge. That tightness is not visible during sell-offs. It becomes visible when inventories shrink and lead times extend. By then, the market narrative often flips abruptly from surplus to shortage. And strategic planning requires anticipating those inflection points rather than reacting to them. It means evaluating reserve quality, extraction feasibility, refining bottlenecks, and recycling innovation. It means funding research to reduce material intensity, while acknowledging that aggregate deployment may still increase total consumption. And there is also an environmental calculus. Sustainable mining practices, circular economy models, and material recovery technologies will shape long-term supply profiles. Investment in recycling infrastructure can mitigate pressure on primary extraction while stabilizing input availability. That is not merely an environmental imperative, it is an economic hedge. And the phrase "not a real market" can be interpreted as a critique of transparency and alignment. A real market should transmit information efficiently across time horizons. When it transmits mostly short-term stress signals, long-term clarity diminishes. Yet clarity can be reconstructed through data. Installation rates, capacity additions, manufacturing output, research breakthroughs. And in that reconstruction, the central question remains unchanged. Is the world electrifying at scale? Are renewable deployments increasing? Are grids modernizing? Are industries digitizing? If the answers remain affirmative, then materials integral to those processes retain strategic relevance, regardless of episodic price behavior. And transformation at global scale is uneven. It advances, pauses, recalibrates, and accelerates again. Volatility is part of that path, but it is not the destination. The destination is a more efficient, software-optimized electrified infrastructure, capable of supporting billions of people with lower emissions and higher productivity. And in such a framework, materials are not speculative tokens. They are functional components of progress. Markets may oscillate between excess enthusiasm and excessive pessimism, but the architecture of the future is built on engineering constraints and innovation momentum. As long as those forces remain active, the gravitational pull toward electrification and scalable energy solutions continues to shape reality beneath the surface of price charts.